Let's get in an expert opinion now to tell us how to wade through these difficult times across global markets. Marc Faber joins in to talk about that. Marc, good morning and thanks so much for joining in on the show. The financial markets are globally obsessed with whether the Fed will withdraw the stimulus or not. What is your observation? Do you expect the Fed to continue pumping the system with liquidity?
First of all, I'd like to say that whenever the market is obsessed with one indicator, I experienced that in the 70s it was money supply, then in the 80s it was the deficit and the employment and so forth and so on. Whenever the market is obsessed with something, it usually loses its relevance. But I believe that the Fed will continue to monetize. Yes, I think we had QE1, QE2, now we're in QE3. I said already in 2009, when they started with QE1, that we would go up to QE99. In other words, there will be an unlimited quantitative easing over time, and I still believe that. The only thing is that over time, the impact of quantitative easing, in other words, money printing, loses its traction. And what it has done, this quantitative easing, is actually it hasn't boosted employment for the ordinary people, but it has boosted the asset prices that are owned by a very small portion of the population, the so-called 1%, but it's not even 1%, it's maybe 0.5% that benefits from rising stock prices, rising high-end property prices. In the Hamptons in the US, property prices over the last 12 months are up 35%. But it doesn't benefit the man on the street. But I think they'll continue to do it.
Marc, good morning. Thanks for joining in. What's been consistent, though, is that the mother market, i.e. the US, has been fairly strong. We've seen the S&P move from strength to strength over the last couple of months. What's your sense of where those markets could be headed? Because that would have ramifications for other equity markets.
Well, basically, we've gone up to the peak on May 22nd. The peak was at May 22nd at 1687. During the preceding months, we went up by 7%. So you take 7% times 12, which would be an annual gain of 100%. I don't believe the S&P will go up 100% in the next 12 months at all. I rather think that the market is very high, that if we make a new high in the next, say, 2-3 weeks, it will not be accompanied by the majority of shares. But in theory, the market could make a new high just on the back of strengths in IBM, Microsoft, Intel, with the rest not moving. It's like in 2012, until September, the Nasdaq was driven by Apple and not by other stocks. And so you can have a distortion in the index just because of a few stocks moving up. But the fact is that a lot of shares are already down 10–15% from their highs. The fact is that in emerging economies, the markets for emerging economies by and large peaked out in January. Now we had strengths in Japan until recently, but as you know, within a few days it dropped 15% of the peak.
How are you feeling about emerging markets as an asset class then, Marc, with specific reference to India? I mean, how would you rate it among some of its Asian peers now?
Basically, if you look at the total pool of money in the world that is floating around, there's little money that has been invested in India. India is a huge country in terms of population. They will overtake China in a couple of years' time. The government in India is horrible, but it's also horrible elsewhere in the world. That's the problem. So India doesn't stand out as the worst government in the world. The others are not much better. The others are maybe better public relations than in India, but they're the same. But at least in India, compared to China, You have world-class companies that are well run, that have a strong growth potential because they have quasi-monopolies, so they can expand in India, in retailing, in manufacturing, in distribution, in pharmaceuticals and so forth, because the markets are not yet saturated. So overall, I believe in investing in India, and I wrote at Christmas that I haven't increased my positions in any Asian markets except in India. At that time, that was November, December 2012. And I also increased my position, interestingly enough, in Iraq, because I think that the market in Iraq is very depressed.
It is good to know that you've increased your investments in India, Marc. But you mentioned a bubble in asset prices. What did you mean by that? What should investors be prepared for? Is there a larger economic problem looming which markets should be worried about now?
Well, first of all, as I just mentioned, the Japanese market had gone up 70% between November and 2 weeks ago, and then corrected by something like 15%. I think what investors have to be prepared for is much higher volatility in the second half of this year. Secondly, in terms of economies in Asia, there has been a remarkable slowdown in economic activity. Say, I live in Thailand, I can see it, that the economy at the present time is not in recession, nor is it in depression, it's just not growing anymore. And the Chinese economy is not growing by 7.8% as the government is saying, or the statistics would suggest. The Chinese economy at the present time, in my view, is maximum growing at 4% per annum. There has also been a meaningful slowdown in Indian growth. In Singapore, where the statistics are relatively honest, in the fourth quarter, GDP was contracting. In the first quarter, it's growing at less than 1%. These can be statistical aberrations. Europe is in recession. Look, when McDonald's announces that Asian sales are down 9%, believe me, the Asian economies are not exactly booming. And when Caterpillar Tractor reports that sales are down 20% in Asia, it tells you something about the Asian economies at the present time. We're not in a traditional recession where everything is depressed like during SARS in Hong Kong. But it's just not growing anymore. And the corporate profits, by and large, are now beginning to disappoint.
Right, Marc, we'll have to leave it at that. Thanks so much for joining us and giving us your thoughts. That's the word coming in from the investment guru. The Fed might continue with its monetary program, but then there are bigger problems in terms of the Asian economy slowing down, etc.